Is the Reliance Nippon Life Wealth and Insurance Plan the right solution for both your investment and insurance goals? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. This is a unit-linked, non-participating individual life insurance plan. Some of the key features of the policy are: this is a single policy that combines wealth creation with life cover. It has flexible premium payment options where you can choose from single pay, limited pay, or even regular pay. And you can also customize your life insurance coverage to match your financial goals, and you can easily switch between active and auto-managed investment strategies as per your preference. And you get to receive wealth boosters annually starting from the end of the 8th policy year, and you can also access your investments during financial emergency and enjoy tax benefits as per the applicable tax law. So these are some of the key features of the policy, and there are benefits like maturity benefit, death benefit, and wealth boosters. And it also has investment strategies like self-managed option, auto-managed option, target maturity option, and life stage option. So there are 4 investment strategies and 7 fund options, which are categorized based on the percentage of allocation each fund option has to asset classes like equities, debt, money market, and also according to the risk profile each fund option has. These fund options are categorized in this tabular column for your easy reference, which you can pause and see. And there are various charges as well, like premium allocation charges, policy administration charges, mortality charges, fund management charges, partial withdrawal charge, discontinuance charge, and switching charges. So all these charges increase the overall cost for investors, especially since similar charges are not found in other market linked products. So many of these deductions persist throughout the policy term, and over time they can considerably erode your investment returns. You need to consider this as a drawback and think whether investing in this is worth this drawback or not. So now, as we have a basic understanding of this policy, let us move on to the analysis part of the video. So if you want to know more about these aspects of the policy in detail, you can refer to the policy brochure. Now let us take a look at the advantages and disadvantages of investing in this policy. Let us first start with the advantages. So you have the option to make top-up premium payments for enhanced investment, and you can fulfill emergency fund needs through partial withdrawals after 5 policy years. And with the self-managed strategy, you can switch freely among 7 available funds during the policy term based on your goals and market view. You have the flexibility to redirect your future premiums under the self-managed investment approach, and at maturity you can choose between a lump sum payout or a structured income through the settlement option. So these are some of the advantages. However, the disadvantages are loan option cannot be availed against this policy, and limited access is available to your investment during the first 5 policy years, and applicable charges are deducted before investing the premiums, which reduces your initial investment amount, significantly impacting the returns in the long term. So you need to consider all these drawbacks before deciding to invest in this policy. So now, to calculate the internal rate of return, which is the IRR of this policy based on the benefit illustration given in the policy brochure, we are going to assume an example. So we are calculating the internal rate of return to help us determine whether this investment can keep pace with inflation or not. So this will help us make an informed decision. So for example, let us assume that a 35-year-old male opts for this plan with a 20-year policy term, paying an annual premium of 2.5 lakhs. The sum assured is 25 lakhs. By the end of the policy term, he will receive the fund value along with wealth boosters, assuming he has paid the premium payments consistently. So in the policy brochure, they provide you with 2 example returns at 4% and 8%. So these are non-guaranteed returns, and they do not indicate that these are the only upper or lower limits this policy can give you. This is just for example purposes, just to show you how this policy can perform in both extremes, like in the worst case scenario and in the best case scenario. So at 4% return, the fund value is 63.42 lakhs, yielding an IRR of just 2.21% as per the policy's maturity calculator. And at 8% return, which is the best case scenario, the fund value is 99.32 lakhs with an IRR of 6.16% as per the Reliance Nippon Life Wealth and Insurance Plan maturity calculator. So despite the long-term investment horizon, both the internal rate of return for both type of return at 4% and 8% fall short of typical inflation rate, meaning the real value of returns is likely to be eroded over time. This makes this policy an ineffective tool for achieving long-term financial goals. Moreover, the life insurance cover of 25 lakhs is inadequate for most individuals, especially when compared to the recommended levels based on income and financial responsibilities. So in summary, this policy underdelivers on both fronts, insurance protection and investment growth. So this may not align well with a sound financial strategy. So instead of opting for this policy, a more efficient strategy would be to separate your insurance and investment needs. By purchasing a standalone term life insurance policy and investing the remaining amount independently, you can potentially earn significantly better returns. So let us evaluate this approach using the same financial parameters as before in the Reliance policy example. So for example, for life cover purpose, we have opted for a pure term life insurance policy with a 25 lakh sum assured, which cost us approximately 8,700 rupees per year as an annual premium for a 35-year-old male over a 20-year policy term. So this leaves us with 2,41,300 rupees annually from the original 2.5 lakh budget we had for the premium in Reliance policy. So this can be invested based on a risk tolerance. So if you're a low risk investor, like you're not willing to take a lot of risk, you can invest in the public provident fund, which is a debt instrument. So the annual PPF investment limit is 1.5 lakh. Although the investment amount in this scenario exceeds that limit, this calculation is just used for purely for example purpose. So investing the surplus in a PPF will result in a maturity value of 1.07 crores, delivering an IRR of 6.80%. Despite being a debt instrument, PPF outperforms the Reliance plan's IRR even in its higher 8% example scenario. This demonstrates its strength as a safe long-term investment. And if you are a high-risk investor, which is you are willing to take a lot of risk, then the same amount can be invested in an equity linked savings scheme, ELSS fund. So the maturity value here will grow to 1.94 crores, and after adjusting for the capital gains tax, the post-tax corpus stands at 1.76 crores, yielding a robust IRR of 10.93%. So if you have any doubts regarding how the ELSS tax is calculated, we do have a small tabular column presented on the screen for your easy reference, which you can pause and see. So this comparison here clearly shows that separating insurance from investment is a more effective strategy. Not only does it generate higher returns, but it also offers greater flexibility and liquidity. Then what is the final verdict? Is investing in the Reliance Nippon Life Wealth and Insurance Plan worth it or not? So compared to other market linked investment options, this policy's overall performance is less competitive, making its risk return profile less attractive, and it also has a high agent commission. So for long-term investor, beating inflation is key. So relying on a product like this that delivers subpar returns can hinder your ability to meet important financial goals. So the Reliance Nippon Life Wealth and Insurance Plan unfortunately may fall short in supporting your long-term wealth creation and could even disrupt your broader financial strategy. So a more effective alternative is to purchase a standalone term life insurance policy which provides you with affordable and sufficient life cover. The remaining funds can then be invested separately in alignment with your risk appetite, time horizon, and financial goals. Building a diversified investment portfolio is crucial for reaching life goals efficiently and sustainably. So it is best to avoid ULIPs if your primary goal is wealth accumulation. Instead, evaluate financial products carefully and make informed choices.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.